Hey guys, it's Carter. Welcome back to the channel. Hope you guys are all having a fantastic day today. And guys, today has been a very rough day in the market. We're seeing so much sell-off across the S&P, the Dow Jones, the NASDAQ, and especially tech and AI are absolutely getting obliterated. Now, a very common question that I've been getting asked is, Carter, how can you swing trade during a recession or during a crash? So that is what we're going to be talking about today. Some tips and tricks and things you guys can start implementing in your strategies to make some money. So I hope you guys all enjoy it. And guys, we're going to be doing a massive sale for the Swing Trading Masterclass. Code CRASH, given the stock market crash, code CRASH for 50% off. So check it out down below. I'll see you guys in there. We got private live streams, we got quizzes, lectures, my strategies, how I find undervalued stock. So check it out down below. And guys, let's dive into this here. So when it comes to swing trading and trading in the market in general, I definitely think that a lot of people think you always need to trade. Every single day you have to trade a stock. You got to buy a position. In reality, it's always better to trade high quality stocks that meet your strategy than trying to force a stock to meet it. There's that huge difference. And the reason why this is so important, and the reason I want to talk about this today, is because during a recession or during a crash, you will see a bunch of volatility. You'll see stocks squeezing up, squeezing down. So my biggest recommendation is choose high quality stocks and take your profit a little sooner and cut your losses a little sooner as well. Have a little tighter stop loss and and take profit a little sooner because stocks are more likely to sell off. The second thing I want to talk about is you can make money when the stock market actually goes down. You can short different positions. Shorting is when you borrow shares from the broker in hopes to buy them back at a lower price. The main issue I have with shorting is there's no max amount of money you can lose. And the reason why is because if let's just say you buy a stock for $1, the worst that can happen is that stock goes to zero and you're out $1. Compared to if you short a stock at $1 and it goes to $2, $5, $10. Now, instead of being out just $1, you can be out $9, $10. So the risk level is a lot higher because there's no max amount of money you can lose. And it's pretty hard to actually find stocks that you can short because your broker has to have shares available. But let's talk about some other things here that I do want to show you guys. So when it comes with evaluating stocks here, I definitely think that a lot of people need to look at the screeners and see what stocks are performing bad and performing well, so you can avoid some of those. So looking at this, you guys can kind of see if you're going to trade a stock here, you're going to want to try to trade real estate or customer defense or utilities. Looking at these here, you guys can see in the past week, utilities is actually up. Real estate is almost break even. Customer defense is only down a little bit. Past month, real estate, utilities. So now as you look at these, you understand what type of stocks have a higher chance of making you money. And if you're going to try to short a stock, obviously try to short like technology or technology, energy, financial. All those stuff you guys can put in your screener, in your scanner, and I'll show you guys how to do that real quick because it's super simple. When you go to the screener tab on Finvest, all you got to do is go to the sector and pick the stock you guys want to buy. So if you want utilities, all you got to do is click that, and now you have all of the utilities, and then you can actually go in and change whatever you guys need to change to find those opportunities. Another thing here is just because there is a crash or a recession does not mean your strategies won't work, but what is more likely to happen is just a little more sell-off. And another thing here as well, before I show you guys a simple strategy here, I also want to talk about historically with crashes, they last about 14 months. On average, the past 90 years, the average crash lasts about 14 months, okay? Given sometimes it will take longer, sometimes it will take shorter, but that's the average, okay? So now look at sell-off, especially with blue chip stocks, as a massive opportunity to start buying blue chip companies at a very, very cheap price. The top ones that I am currently owning right now are Google, Alphabet. I bought some Meta and some Costco. All these companies, looking at them, you guys can see that given this stock sold off from 191 all the way down to 156, and we actually got a little move going up. So looking at sell-off is actually a huge opportunity to buy companies at a cheaper price. I bought some more Microsoft. Now my average cost is a lot lower. I bought some more Meta. I bought some, Costco. I'm looking at sell-off as the best opportunity to buy companies that I believe in and that I understand. And I completely understand that technically it's not a swing trade or whatever, because it's going to be more of a little bit of a long-term play. But I really think that if we can get a recovery in the market in the next couple of months, you'll see a lot of these blue chip stocks perform very, very, very well. Another thing here is historically, through all the ups, through all the downs, the depressions, the recessions in the market, dividend stocks always perform better than non-dividend stocks. And that's because people are less likely to sell dividend stocks that's paying them cash and hasn't sold off as much. So understand that, and you guys can, incorporate that maybe in your portfolio. So looking at a stock like ARCE, you guys can see here, great upward trend. Sold off down to the 200-day moving average line. Looking at the hourly chart here, you guys can see this thing just stair step down after hours, and immediately during the market hours is starting to get some buying pressure. So, looking at sell-off as opportunity, right? You guys can see even the separation from these moving average lines. We could take a trade to see if we can get a push up from like 19 to $20, which is a 4% return. 4% I'll take out any single day of the week, right? All right, so now that we understand some basic tips and tricks when navigating, swing trading and trading during a recession, now let's show you guys a very, very simple strategy you guys can do to actually short a position. This is using basic support and basic resistance lines. So looking at a stock here, ticker symbol HOLX, what do we notice? The stock really doesn't have an upward trend nor a downward trend. It's just a very, very flat stock. But what this does have is very, very hard support lines and resistance lines. So looking at the stock, if you wanted to buy this stock, you'd want to try to buy it down here near and around this $60 mark. If you wanted to sell this position, you'd want to sell it up here at 82. Every time it hits 82, we get recent sell-off. So you guys can see it hits it in the past, we got sell-off. Hits it in the past, we got sell-off, hits it again, more sell-off. Recently, the stock hit it again. Now, another indicator we use is something called the RSI. The RSI stands for the Relative Strength Index. This pretty much tracks momentum. Historically, anything over 70 is a little overvalued point for the stock, and we could get sell-off. So looking at the RSI, you guys can see it's trading for near and around about a 72. The last time it was trading for a 72 was back in here where we had a little sell-off, but previous to that was back in here where the stock was trading for near and around $87 and went from 87 all the way to 64. So looking at several indicators to determine if you should buy or sell. Another indicator is called the MACD. The MACD is a pure momentum indicator, and historically what we want to look for is when the signal line, aka the orange line, breaks down through the blue line. It hasn't hit it yet, but definitely looking for a opportunity, and looking at this indicator is a very, very good indicator to determine that, because you can see in the past where it actually hits it here and we get that sell-off shortly after, and previous to that was in here shortly after. So looking at that sell-off as opportunity, right? Looking at an overvalued point is always very, very, very simple. This is basic resistance and basic support that you guys can do to start shorting opportunity in the market. So let me know your strategy down below, and I highly recommend checking out the Swing Trading Masterclass, and we'll see you guys in the next one. Take care.